second video on audit planning, and today I will be covering the first part of the syllabus of audit planning, that is defining materiality and performance materiality to demonstrate how it should be applied in financial reporting and auditing. So the purpose of this is to understand the concept of materiality and differentiate between materiality and performance materiality. Again, I have broken the requirement into two parts. Firstly, I have listed all the pointers that pertain to materiality, and then I have listed all the pointers that pertain to performance materiality. So we can go step by step. At the same time, I have also mentioned how it can be used to demonstrate and how it can be applied in financial reporting and auditing. So firstly, here's the definition of materiality. The objective of an audit is to express an opinion as to whether the financial statements are prepared in all material respects in accordance with an applicable financial reporting framework. It is therefore of vital importance for auditors to apply the concept of materiality in planning and performance. Misstatements, including omissions, are considered to be material if the individual or in aggregate could reasonably expected to influence the economic decisions of user taken on basis of financial statements. This is the pure definition of materiality. Now, how do you determine materiality? This is the calculation. Materiality in planning and performance and audit recognizes and permits the use of benchmark calculations of materiality. Okay, the traditional calculation basis is as follows. So now this is the criteria. So for pre-profit tax rate, the value could be 5 to 10%, and it is only appropriate where users are mainly interested in profitability of the company. Similarly, for revenue, the value should be 0.5 to 1%. Materiality by reference to the size of the business can be measured in terms of revenue. And for total assets, it's 1 to 2%. Size can also be measured in terms of the asset base. Now, these benchmarks should be used in the initial assessment of materiality. When deciding on appropriate benchmark, the auditor must consider these 2 points, the elements of financial statements and whether particular items tend to be the focus of the users. These 2 points are extremely important because once you set the right benchmark, only then you're able to calculate materiality properly. These are the three additional benchmarks: the nature of the entity, its life cycle and environment, the ownership of financing structure, the relative volatility of the benchmark. Now, some uh, times what happens is materiality is by nature, and this is also explained here that some items may be material by nature because of the impact they have on financial statements, and the examples includes the following. For example, misstatements that affect compliance with debt covenants, misstatements that would turn reported net position, net profit into a loss for the year, net misstatements that would turn reported net asset position into a net liability position. So an example could be, for example, you might have failed to include a receipt or a discount that you have given to your customers. If you do not treat that discount as an expense in your financial statements, then you might be showing a loss as a profit because the expense has not been included. This is all that I could collect from the study text and the notes available online on materiality. Next up is performance materiality. Auditors cannot identify individually material misstatements. It is much more common that misstatements are material in aggregate. For this reason, auditor must consider performance materiality. Some statements might not be material if looked at them as a whole, but when you combine them together, they might reflect a higher percentage of materiality. So performance materiality is lower than actual materiality because the idea is to prevent all those small undetected errors to not aggregate and become material. So what is it? It is more like an amount that is set by the auditor at less than materiality for the financial statements as whole to reduce it to an low level. The probability that aggregate of uncorrected and undetected misstatements exceed materiality for financial statements as a whole. The aim of performance materiality is to reduce the risk that misstatements in aggregate exceed materiality for the financial statements as whole. The two ISAs to consider are 320 and 450. Why do ISAs are to be considered? Because the new standard recognizes that there could be instances where certain classes of transactions, account balances, or disclosures might do bold might be affected by misstatement which are less than the materiality level for the financial statement as whole, but which may influence the decision of the users of those financial statements regardless of the fact they are below materiality. So this is where the performance materiality needs to be applied when classes of transactions, account balances, or disclosures are less than the materiality level of financial statements, but they do influence the decisions of the users of those financial statements. So it was very short, and I've kept it very brief. Um, Next video would be up on part B. I can give you a brief snippet of it. Here is it. Evaluate business risk, audit risk, and risk of material misstatements for a given assignment. Now it's a very detailed, it's going to be a very detailed discussion on business risks, audit risk, risk of material misstatements, because all these are interlinked, but they are very different from one another. So if you have any comments on my video, if you think my conversational style or the way I'm presenting content would be improved, please don't forget to mention in the comments.